We will start momentarily. That's what I was waiting for. Hello, everyone. Thanks for being here. I'm going to give people a few more minutes to get settled, and then we'll start. All right. Well, I have some housekeeping to do, so let's dive in. Welcome to our intro call with AZTLAN. Thank you for being here with us. I'm Stacy Havener, founder and CEO of Havener Capital, and we are AZTLAN's marketing partner, proud to be, and I'll be your host for today's call. So today we're going to embrace the idea that we are all ands, not ors. We are going to own our left brain logical side and our right brain creative side. And we're also going to meet the guy who gets my vote as the most interesting man in the investment world. And I will try not to break into a Lady Gaga song as I introduce him. But I am proud to have Alejandro Garza, founder and chief investment officer of AZTLAN Equity Management, here with me today to talk about his backstory to founding the firm, what they specialize in at AZTLAN, how it's different, and why it lights them up. We'll also get some insights into the international markets and landscape right now. I know many of us are fans of EM, and we're all waiting for a spark there. So I'm going to ask Alejandro to tell us what's going on. Alejandro, thanks for being with us today.
Stacy, thank you so much. Thanks for hosting today's webinar. Thanks to Havener Capital. There's a lot of work on the background that has been done in the production of this webinar. So thanks to the team as well. Hi, everyone. Welcome. And yeah, ready
to go. All right.
Ready to go. Thanks for that introduction as a
Oh, you're so welcome. Well, listen, we're going to have fun today. And I want to encourage everyone, couple more housekeeping before we get into it. So I want to encourage everyone to sign up for AZTLAN's research, their newsletter on their website. And I'm going to ask Alicia to pop a link into the chat or whatever tech magic happens there so you can easily get over there. Follow them on LinkedIn. Let me just say this. They have a 90 some odd page chart book on their website that I know you will geek out on. So that's fabulous. Hop over there, sign up, follow them. You will, as for today's call, as it relates to questions, that is our favorite part. You will have the opportunity to submit text questions. I think we're all pros on Zoom, but just in case, you can submit them in the Q&A in the control panel there, or you can put them in the chat. And I'm going to try to figure out how to multitask, and we'll get to Q&A at the end. We also had some great questions pre-submitted, so thank you for that. And we will try to get to as many of the questions as we can. If we don't get to your question today, though, rest assured we'll reach out to you directly to discuss further. And with that, we're going to get started. Alicia, is there a way for you to take the slide down so it can just be, there we go. That's what I like to see. Alejandro, can we start with my favorite part, which is the backstory? And I have the privilege of knowing some of it, but I really want our listeners to get a sense of, your journey to founding your own firm. Let's start there.
Absolutely. Let's dive right into the backstory. Let's see, where do we start? So first of all, AZTLAN Equity Management is a U.S. company. We started the company and registered with the state of Virginia back then. Why Virginia? Well, I was there prior to starting AZTLAN. I spent 10 years in Washington, D.C., in the Washington, D.C. area. First with a firm called Emerging Markets Management. Why such a generic name? Well, because these guys invented emerging markets. Really, they coined the term, and they were the first to create an investment strategy for emerging markets equities. And then with the Ashmore Group, the Ashmore acquired EMM, Emerging Markets Management. And so in total, I spent 10 years in the Washington, D.C. area. By the time that I had a very clear vision and I said, I have to do this, I won't be happy with myself if, I turn 80 and I look back and I say, I could have done this and I didn't. I have to do this. So that's why McLean, Virginia is where we started in the US. I am originally from Mexico, Monterrey, Mexico, which is, by the way, where I am right now physically. This is, the background is our offices in Monterrey, Mexico. We have presence in the US, in Mexico, Argentina, and Hong Kong. But then, going back to the backstory and how we started AZTLAN, it was really out of having a very clear vision of how I thought international investing could be done. And I was, confronted and I had to deal with all these impediments that were part of, being an investment manager with an institution, a large institution, with, a lot of things that go on that in the end, all these things just become impediments to implementing things that I thought were really important to implement to have an efficient process. So that's really the reason why, in summary, the reason why I started AZTLAN Equity Management. We'll talk a little bit about the philosophy and all the, technical stuff in terms of how we implement this vision in terms of investing in international equities and international markets. But that was really the reason. And then how I got there, how I got to emerging markets management in the first place is also an interesting story. The specific reason or link was my previous boss at the time had a dinner conversation with the CEO and the lead portfolio manager of emerging markets management at the time. We're talking about 2006. So in that conversation, he was no longer my boss. He was out of the company that I was working for. She said, we need someone to manage or analyze equities in Latin America. That was the ask. And this guy, Alvaro Rodriguez, recommended me. So that's how I got this mysterious email saying that, if I would agree to an interview in Washington, D.C. I said yes. And that's how I started my way into the investment management world. Before that, my expertise was in finance, but not necessarily in investment management. It was in corporate finance and M&A.
Okay, so this is great. And everybody, you're seeing this happening live. Like, this is the type of stuff I love, because I'm going to ask Alejandro to go back even further.
Okay.
So I love the part about EMM, and it's like, as you said to me, it's like the Kleenex of emerging markets. Like, Kleenex it was the name of a company. Now it's actually the thing. Like, can you pass me a Kleenex? That's why, right. It's like, because I can never remember the name, but so that was great. But I want to go back. I want to go back because you didn't start out saying, when I grow up, I want to be a fund manager. That wasn't what you said, was it? And I want
this industry existed.
Yeah. So I want to talk about the fact that you originally set out to be an artist, because I think that really ties this theme of left side, left brain, right brain together. So can you talk a little bit about how you even came to know that the investment management world existed, since you wanted to be an artist?
Exactly. Yeah. So I let's say from the time I started my professional career to the time I knew the investment management world existed and the emerging markets investments were investment class of their own, there's like 15 or 20 years in between. Back when I was in college, I was well, I have to say I'm a chemical engineer. So I wasn't necessarily interested in the finance industry at first. I was really looking at chemical plants and petrochemicals and all these things. But I was also very interested in art, and I was also formally trained in painting, uh, classical painting, and then more modern kind of stuff. Actually, when I was in my, I think, sixth semester of chemical engineering, I had the opportunity to exhibit my works of art in the library of the university. I
Oh,
keep
that's
a
awesome.
little diploma of that thing that I was, the dean of the university was there, and it was a nice little event that allowed me to mix those two things, right? And my alma mater, where I was studying, I became a chemical engineer. I had the opportunity to make one of my first art exhibits back then. So as a chemical engineer, I started working, a couple of years of experience in the industry. I was really getting really anxious that my true passion was in the arts and painting, and I had my studio, and I had all these aspirations. I want to show my art to the world and be able to create this huge piece of art. So by chance, my father introduced me to an investment banker, Oton
Mhm.
Ruiz. And so Oton Ruiz was an investment banker for this boutique advisory firm in New York, specializing in mergers and acquisitions, particularly in Latin America. So Mexico, Central America, Colombia, Chile, Peru, all these large corporations. They went to this particular place in the 90s for M&A advice. So there was this connection with an art gallery owner in New York City that I said, okay, I have to reach out to this guy so that I can get my way into the art world. So with that in mind, I asked for an internship at this investment bank. I got the internship out of the, I don't know, 20 junior analysts or summer staff. I got a job after that summer, and I liked it. I thought, what, this is interesting. I'm good at this. Pays well. Uh, I might as well just stick to it, and that was my way into the finance.
Love it. Well done. I'm thank you for taking us back a little bit and giving us more context, because I think, well, first of all, I just love people's stories, and it's so interesting to me. Maybe the only person that took an internship in iBanking to get into an art gallery. Like, I don't think that's the normal path, but I love it because it makes so much sense as we dive into your philosophy of combining quantitative and qualitative, of combining kind of the science of investing with the art of investing. And I think that backstory really brings it to life. So thank you for that. Can we take it to, where do I want to go next?
This
Let's
is 30
kind of,
years ago,
let's,
Stacy.
yeah,
Okay, so you
yeah.
made back 30 years into the past.
I have to. I have to, because those are the things, you know why? Because the people on this call and so many allocators tell us this. This is the stuff they can't get anywhere else. They can't pull up a database and say, okay, like show me all the managers with cool backstories. Like, there's no screen on that. So this is intel that they can't get. If you're with me, I need some sort of like a high five or something on that. Okay. So what I want to do next is I want to talk about, so here you are. So your background, a lot of EM. Now you launch your own firm. No secret, EM's getting completely, has had a rough run, and I want to talk about that later. But you also had this kind of specialty in international SMID. And so how is this expressing? Like, let's kind of go into how are you expressing this quantitative and qualitative? What do you specialize in?
What do we specialize in? Or yeah, so when I started AZTLAN Equity Management, because I was coming from a 10-year period where I managed emerging markets equities. The first strategy that we launched was an emerging markets small and mid cap
Makes
equity
sense.
strategy.
Yep.
Why small and mid cap? Because I have this conviction that the small and mid cap space is the optimal space for stock picking. The larger companies, they're already in the portfolios, they're already in the index, the ETFs, etc. The smaller micro companies are not investable in many cases. So really this, small and mid cap from, let's say, 1 billion to 10 billion market cap range is where you have these really interesting companies. And oftentimes you find companies that have all the qualities that we would look for in an ideal situation, value, quality, growth. So that's why, the first strategy was emerging markets, small and mid cap. We struggled. It was not easy. Actually,
Yeah.
it has not been easy to raise assets or to have an investment strategy for investors in the emerging markets space. The asset class has suffered a lot over the last 5 years. And so what we did very quickly during the first year after starting AZTLAN, we pivoted. We saw, okay, emerging markets is where we have the track record and the specialty, but what we know and what we know how to do well can be applied to international investments as well. We can look for small mid-cap stocks in the US, in Canada, in Europe, in Japan, and the Nordics. So we launched our second strategy, which has become, and to this day is now our flagship strategy. We launched our global developed markets, small mid-cap stock picking strategy. And so that's really what we specialize in. We specialize in stock picking, small and mid cap space, international equities. And to do that, we need to have a method for that, right? We can't go about, I have an idea and just implement it. No, you have to have a systematic way of approaching.
So I want to dive into that. So that's great. So I love the nuance on SMID, that there are still opportunities there. I want to also talk about conviction, because you mentioned it. And when you say conviction, everybody has a different definition of conviction. Like some managers will say, I have a high conviction strategy, it's got 50 names in it. What do you mean when you say high conviction strategy?
That's the other thing. High conviction and high concentration are almost the same thing for us. In my mind, and also I was mentioning this in a post yesterday. The conviction in terms of having high concentration strategies comes from both experience. Empirically, I know that having a beyond certain number of stocks in an equity portfolio, the diversification effect actually counters what you were looking for, and you get diluted returns, and you resemble the benchmark, and then you underperform the benchmark. It's not good for anyone, and you're not doing anything, you're not bringing any value to the table if you have a 200 stock portfolio, in my opinion, and in my experience.
Agree.
Mathematically as well, you can mathematically derive what is the number of assets that you need in a certain portfolio to maximize diversification with a minimum number of different assets. So what does that mean in terms of a number? 20 stocks. So the ideal portfolio, 20 stocks. And if you want to build an investable portfolio with 20 stocks, you have to be in the small mid cap section, and you have to screen for liquidity. You have to be very careful in certain aspects, but it's really that kind of concentration. The 20, what we're looking for really is, where are these, the best possible businesses in the world? We want to find them, analyze them, understand them, and bring them together in a single strategy. That's what we're looking for.
Awesome. I love that. And if people have questions around conviction and how they're building that portfolio, we can come back to it, because I do think that's really different. And it speaks to a lot of the reasons why investors gravitate to boutiques, right? It's this high conviction. It's A names, not C names. It's, capacity, constraint, alignment, and all that stuff. So I think that's perfect. Thank you for addressing that. And you alluded to this a bit. I'd like to unpack it more. So you're going to find these 20, best in class small to mid cap companies globally in the international markets primarily. So how are you going about that? Because is this qualitative, quantitative? Is this top down, bottom up? Like we're ands here, and that was the theme at the top. But like, what's different about your philosophy, would you say? And how are you thinking about, the dichotomy of those styles, if you will?
Yeah, no, great point, Stacy. I think, and to say it succinctly, and then elaborate on it. We're bottom up with a top down overlay. That's what
Okay.
we're. So bottom up. What does this mean? Bottom ups means we're stock pickers. We want to identify specific businesses. What I discuss with my colleagues, with the analytical staff, primarily with the more junior staff, is, but with everyone, we're looking at businesses. We're looking to invest in other businesses. So we need to understand what these businesses do. We need to go beyond the Excel spreadsheets and the numbers. These are actual businesses that produce things, services, etc. We want to identify the best possible businesses in the world. So how do we do this? Since we're bottom up with this macro or top down overlay. What we've done is we've created an investment process that incorporates all the experience that we have accumulated over the years, and that I think is exactly the reason why I started AZTLAN, and I said I have to do this because I have a real vision of how this can be done. What is this process? What is this investment process? We have a 4-step process. It's really very simple. We start with quantitative screening. That's crucial. I think it's impossible, or yeah, I would say impossible to get an adequate investment process without a quantitative model at the base.
Okay.
Otherwise, we have a 5,000 investable securities in the world. How are you gonna come about that 1,000 investable universe to pick the 20 best? We need a model. So we have a quantitative model, and that's how we start to incorporate some of the more scientific aspects of the investment management profession into what we do. So we have our proprietary quantitative process or model. Our model incorporates our investment philosophy. That's super important. Our investment philosophy is very clear. That's the first step in creating an investment management operation. We have an investment philosophy, and that investment philosophy is in direct alignment with the quantitative process. So that's step number one. What's in the quantitative process? It's also very simple, and we don't like secrets, and we like transparency and openness.
Yeah.
Return on equity,
Good.
Free cash flow generation, earnings growth, adequate leverage in terms of the balance sheets. Price or not price earnings revisions. We want to
Okay.
some information that's incorporated into the earnings revisions process, and a lot more information nowadays versus 10 or 15 years ago. So these are the things. It's just plain common sense, I would say, that we incorporate in a quantitative framework, scientific approach. Step number 2 is okay, so we have a quantitative process. We're able through that process to rank 5,000 securities from top to bottom. So we're going to look at the number 1 or number 2 in each region sector of our entire investable universe. We have 3 regions: North America, Western Europe, Developed Asia. We have 11 or 12 sectors. So let's look at the number 1 or number 2 stock in each of those buckets. And as an analytical team, with our team is comprised of 15 analysts, as I mentioned, Mexico, US, Argentina, and Hong Kong. And so we do the fundamental analysis. We do a full fundamental analysis. We analyze the company as if we were to buy the company 100%, like a full buyout. Full due diligence, understanding the company, reaching out to management, having conversations with them, due diligence, visiting the premises prior to the pandemic, and now again resuming that practice. And so doing the full fundamental analysis of a company, including valuations, and having an investment committee to evaluate and to act as a sounding board in terms of what we have analyzed. So that's step number two to the whole fundamental analysis. Includes all these discussions in terms of the investment committee that we can go into in more detail. Step number three is once we've discussed and we come to the conclusion that these are, some of the best companies in the world, we put them together in a portfolio that provides adequate diversification. Super important. Since we're very concentrated, we want to make sure that in our third step, we're building a portfolio construction with adequate diversification. We want to be very aware of what are these different businesses in terms of the regional risks, the industry or sector risks, and the specific risks to each of these businesses. So we want to have this, 20 stocks that each of them are completely different to the next one. Maximize that diversification. So we're not going to pick, two industrials in the same country. We want to pick the best industrial company in the US, the best one in Japan, the best one in the Nordics, for example. That's step number three. Also very scientific and systematic, but also a lot of creativity involved.
Yeah, I would imagine.
How we, put together all these different portfolios in a very unique way. And then the final step is a continuous monitoring of the portfolio companies. And the monitoring is not looking at a monitor, as the word implies, but it means staying very close to the companies. We are investors. We are co-owners of these companies. And so we want to be in touch with management. We want to be very active in the sense of we want to know what's going on in terms of the strategy, the markets they're in, etc. Not to say, and important to clarify, we're not an activist fund by any means, but very active in the sense of staying very close and in constant communication with the companies that.
Oh, I like that. Yeah, I like that.
That's the process, 4 steps.
Okay, so I have some questions. That was super helpful. I'm going to ask you some questions and a little bit of a challenge in here as well. Hope that's okay. So, okay, love this. Talk to me about the top down though. Because right now that's very, very bottom up. And so I'm sitting here thinking, all right, but in EM and international markets, maybe not the US, but maybe it's true there too. How does the top down weigh in? I mean, how are you marrying that part? Like, country, we like China, we don't like China. Or how does that play into the portfolio construction? Because you've got only 20 spots in this portfolio. How do you think about the top down?
Absolutely. So the top down, as we discussed, is our final overlay. Once we have everything built, we have this final overlay. It's like all these layers of an onion. In our case, the macro and the geopolitics, which are the 2 key components.
Yeah.
These 2 things are part of our investment committee. These 2 things are part of our discussions. So to give you a couple of examples, we cannot possibly be experts on everything. So, we're not, experts on geopolitics. We're not economists, we're investors. So definitely we need to rely on third parties, research, experts, etc. But in terms of how this trickles down to the portfolio or the portfolios is through the investment committee discussions. And so we have all this, research that is going on. We put together all these research reports, and we discuss them in our investment committee. That's the key and the primary way that this feeds to the whole investment process and the portfolio construction process. So to give you an example, we just published yesterday or the other day a summary report on currencies. So that's a very macro top-down kind of variable that goes into the whole portfolio construction and investment management process. We do have that is perhaps currencies is a lot closer to what we do in terms of analyzing fundamentals and coming up with models. And through those models for the different currency pairs, the Japanese yen versus the dollar, the euro versus the dollar, we have these discussions, and that also informs our regional or country allocations, right? So if the bottom-up model says overweight Japan, but these macro considerations say you know what, be careful because the Japanese yen could, head for significant weakness and devaluation. That informs our process and
Okay.
the decision of, what are the allocations.
That's very helpful. Follow-on question to that for me is tracking error kind of related, active share related. Are you willing to take big bets against the benchmark? In other words, will you have countries, regions, sectors, whatever, that you're just like, we're not in that and we're okay with it?
Oh, absolutely. I mean, by definition, if you have 20
Okay, you have
shares,
to,
you have
right?
to be, 99% active share. That's, one of the key reasons that, you know, led me to the creation of AZTLAN and all these investment processes. Active share. If you don't have a truly high active share, then don't bother. You're not adding anything. You already have indexed funds that you can buy
Yeah.
at a very low cost. So it
Yeah.
has to be active share. In terms of an example, I can give you our small and mid cap ETF. You can look on our website for details on this ETF. But if you look at it, it's a third North America, a third Western Europe, a third developed Asia. If you look at for example, MSCI International Small Mid Cap Index, the US is the largest in terms of the allocation, I think 55 or 60%. Then the UK, then Japan. I think if I have, my memory serves me well, but the point is just by definition, by the way we designed this product, we have this very active share, and our intention is to produce results that are different from the benchmark. That's the whole point.
That is the whole point. Different is better than better. I love that. Okay, I want to take the conversation a little bit into kind of what's happening. Um, and it's not like market update yet. We'll get there. But I just want to talk about international small cap and mid cap, because I think it is, like this whole idea that you're going to generate alpha in the inefficient parts of the market. There's still this belief that active management, to your point, can be additive in this part of the market. And yet, it's not in everyone's portfolio. I want to talk a little bit about the opportunity set and some of the challenges in this space, if you could help us think that through.
Yeah, absolutely. I think this is there are many papers actually written about this, the home country bias. Then also this phenomenon that as investors, what we tend to do is follow the herd. And so what that means is, well, the US market is the largest market in the world. And so US portfolios will tend to be almost, 100% concentrated in US equities. And for that matter, they will be concentrated in S&P or the large mega cap names. So we have that as I'm going to say a fact, but it's an approximate fact, right? We get into details, but it's an approximate fact. And in reality, the US market cap, if you add up all companies, micro, small, mid, large, mega, it's certainly not 100% of the world equity markets. So there's a diversification component. For example, if you're highly concentrated in the S&P or in the NASDAQ or in the different instruments that are available, or in the Magnificent Seven, as they're called today, you have a high concentration risk. They've worked very well last year, but there's no one can tell you that they will continue to work going forward. And what's more important in my view, they're not necessarily the best. They're great companies out there that generate greater free cash flow, that can sustain high rates of growth, compound equity at high rates, that are trading at low valuations. Why wouldn't you want to have a piece of those companies in your portfolio?
Yeah, I think that's right. I think that's right. Thank you for touching on that with us. I'm I want to go, this is kind of, I'm borrowing a question I wanted to ask you later, but I want to pull it forward a little bit because, you know, themes or sort of trends, like as you were talking about the Magnificent Seven, if I put myself in investor's shoes, I'm like, yeah, but it's working and it's hard. If I'm an allocator of capital, if I'm not the asset owner and I have to face clients and they're pointing at their, you know, portfolio, like, why aren't I keeping up with the Joneses, so to speak? That's really challenging. So from a trend perspective, one of the thing or theme, I don't know what to call it, that you've talked a lot about is this idea of nearshoring. And can you talk like, so for me, the first time I heard it, I was like, I don't know what this is. So I'm going to need to go to nearshoring school. So can you give us like a little mini, you know, 101 nearshoring here and kind of show us how that feeds into the opportunity set in the international small and mid space as an example?
Absolutely. Thanks, Stacy, for that question and bringing that up. I think I have to say we're the experts in North American nearshoring. We have launched the first nearshoring ETF, and also I'm all every time that I get a chance to say this, I say it because I'm very proud of it. It's the very first fund that we can find. I don't know if there's something that has gone beyond our research, but as far as I know, this is the first fund that incorporates equities in the US, Mexico, and Canada. No one else had thought about this before. And so this incorporates EM with developed markets, and it goes directly to the nearshoring phenomenon. What this is really geopolitics at its best. What this means is really the US government seeks to maintain the hegemonic position in the world, militarily, economically. And so what that means is in terms of geopolitics and macroeconomics, the international commercial policies of the US have to be aligned with that vision. What that means is that all these productive chains that have been developed over the last 3 decades that rely significantly from supply chains from Asia to the US have to change. The US needs to change those supply chains for strategic reasons, and what that implies is that either some of that production chains that are currently in place have to be moved to North America, or new capacity that is being built for future production and all sorts of industries, but electronics, tech, other sorts of manufacturing need to be established in North America, closer to home, with commercial allies that are closer also to the US. So geopolitics is at the very heart of the nearshoring effect. And the effect is this relocalization of productive supply chains from other parts of the world, primarily Asia, to North America, including Mexico, the US, and Canada. So that's nearshoring. And we created a strategy to take advantage of this phenomenon.
That's very cool. And thanks for the 101. If anyone, everyone else is probably like, great, I already knew about nearshoring, but it's helpful. I think what I want to take the thread and pull forward here is, so why, like, I don't know, might be just me, but I'm like, well, wouldn't that benefit the larger companies? You know, if they saw this phenomenon, wouldn't that be more of a large company thing that they would try to take advantage of? Is it still that the smaller and small cap, mid cap companies are the beneficiaries of this? Is that because they're already existing in there?
That's a great question, and a question that we asked ourselves when we first identified the opportunity and also the challenge, how to create a strategy
Yeah.
that can address this opportunity and something that is doable in an ETF wrapper, right? That is an exchange traded fund. So what we did based on our research and internal discussions, we identified the pick and shovel, so to speak, the enablers of the nearshoring. And so we identified within North America, Mexico, US, and Canada, we identified 5 industry segments that are the first line of exposure to the nearshoring phenomenon. What are these 5 industry segments? Industrial real estate, that's very obvious. Industrial real estate, will benefit from and is benefiting from this effect. Transportation and logistics, they serve all these companies that are relocating to the North American region within this supply chain relocation. Warehousing and logistics, infrastructure, ground, air, and sea infrastructure. And finally, some specialty REITs or real estate investment trusts, like, for example, data centers that serve all these companies that are relocating. So we identified those 5, and then within those 5, we set out to identify the companies that are in fact participating in nearshoring and that have mentioned in their strategies that nearshoring is important for them. And with that, we came to an investable universe of 70 companies that have all these characteristics. And that's how we created the nearshoring strategy.
Got it. And are there 20 names in that as well? Is that kind of the vibe across all the portfolios, would you say?
Yeah, similar, but in the case of the exchange traded funds, we have to comply with certain regulations.
Okay.
So there are minimums that we have to comply with, and concentration, minimums, etc. So we also take all these constraints into consideration in the final design of the product. And in this case, it's 30 names instead of 20.
Okay, gotcha. Okay, great. That's super interesting. And we are here to dive deeper into nearshoring. If anyone has questions there, I'm watching the clock and I want to get to some of the questions that people are asking. There's great questions. As a reminder, you can pop your question into the Q&A or into the chat. And Alicia, thank you for your help as we're going through all this. So if people want to talk more, this can be like another call. What are the options right now? You mentioned you have an emerging markets separate account. You mentioned you have the global, like what are the strategies and vehicles that you offer, basically?
Right, yeah. So we have 2 ETFs,
Okay.
AZTLAN, the small mid cap, and NRSH, the nearshore.
Okay.
Those
Okay.
2 are near stock exchange listed. Anyone can invest, through their investment accounts. In addition to that, we have 2 private funds that are for international investors, Reg S kind of wrappers. And then in addition to that, we have the SMA service available for institutions, family offices, wealth advisors, etc. And through the separately managed account, we have available the developed markets DMxUS, developed markets standard, including the US, and emerging and frontier.
Okay. Fabulous. That's great. So if people want to dive deeper into those strategies and how you can partner with AZTLAN, please reach out to the team. They'd be happy to have a follow-up call with you and walk through those strategies. I want to jump into some questions. We did the nearshoring one, and I see someone's really good. They're putting questions in here. Okay, so we've got some return expectations. Maybe we'll get to those. That could be a second. Let's go over here. This is a good one. How do you value intangibles? Because that's been such a phenomenon, globally that companies, intangible, the value that intangibles are creating in stock market price. How are you contemplating in your models or as a team?
Right. So intangibles, the only way to get to that level of detail is if we pass the first 2 steps of the process, right? So we need to get into the due diligence process, and in the due diligence process, that's a key question that we ask. It's part of our due diligence questionnaire and procedure with companies. We want to look at intangibles, and also I think it's important in our model. One of the key variables is return on equity. Companies with
Mm.
large intangibles tend to have high return on equity metrics. So a lot of the companies that come to our investment committee and that are up for discussion and that we actually do the due diligence and the full process have these kinds of intangibles. And yeah, the only way is by having an adequate staff of experts. In our case, we have 15 analysts working in the team, fully dedicated to the analytical part of the business, to the fundamental part, really. And so that's the only way. It's there's no way around it. You have to dive
Yeah.
in, do your research, ask questions, and get a good sense of what is the value of those intangibles. And it's case by case. There's no other way around it.
Yep. Good old fashioned fundamental research at its best right there. Love it. Okay. Next question. This was a pre-submitted question. All right. What is your approach if one of your high conviction names is falling and or is underperforming with no changes to the investment thesis and no news? How do
Right.
you handle that? Because you have this concentrated portfolio, so you're going to feel it.
Exactly. And that goes back to our investment process. The fourth step is the continuous monitoring. And that has to do with staying in touch with the company and having a good sense of what's going on. Here I have to say, one important thing or one important distinction. The ETFs have all these rules because they are regulated and they're publicly traded, etc. There's a little higher turnover there in those strategies. It's
Okay.
systematic, rules-based kind of turnover that we have there. In our stock picking strategies, we have very low turnover. And the turnover that we do have is usually, within the same names, just rebalancing the portfolio.
Mm-hmm.
And we tend to hold these names for long periods of time. Actually, yesterday in our weekly investment committee, we reviewed, I think, 3 companies that had just reported earnings. So it's regular earnings update. And it was really nice to come to the realization that it's been 6 years with all these 3 companies.
Wow.
Actually, one of them is now a mid cap, and 2 of them are beyond our mid cap range. So they wouldn't be eligible if we were investing day one right now. So
Right.
they've grown.
Let them run. Yeah.
We let them run. So to address the question, you have a stock that is underperforming. Nothing has changed. What do you do? There's nothing we can do but continue monitoring, continue our conversations with management, have this very close communication, incorporate all this information into our analysis, into our discussions, put it to the committee, discuss in the committee. By the way, our investment committee, the way it's set up is not by a majority voting system. That's one of the key takeaways or key lessons learned, at least in my experience. It doesn't work.
Mm-hmm.
Investing by consensus. So what we do is we debate, and we want the ideas to be the center of what we do. And in the end, we want those ideas, the right ideas, so to speak, to prevail. And that is really the only way we can do this. We have examples in which we have thrown in the towel and said, okay, this is not working, and we've discussed it and we can't figure this out. Let's move on. And we also have examples where we're still invested to this day, and they haven't been successful investments, but until we reach the point that through our process and through our dialogue, we reach a conclusion, we can't take action in terms of selling a position just because it's not working. It has to be through the dialogue and the dialogue leading us to the right decision-making process.
That's great. And I want to take the other side of this conversation as well, especially since you're in the small and mid cap space. Probably this is more of a small cap phenomenon. But how often, and someone asked about this, how often are the companies being taken out? In other words, how often are they targets of an M&A or taken private? Is that a phenomenon the way it is in the US for small cap?
In our experience, all the time. It happens all the time.
Yeah. Okay. Yeah.
For those that are interested, we published this some months ago. We were on a very nice streak, but in which I think 5 of our portfolio companies were acquired over a period of I think 20 months. And these are small to mid cap companies, so 2 to
Wow.
5, $10 billion companies that have been taken out. A very recent example is Lawson. This is a convenience store chain operator in Japan,
Hmm.
acquired at a 20% premium, and it's part of the was part of the strategy we sold now, and actually part of the small cap ETF. It's been in the index for the ETF as well. So
Fascinating. And I think that ties back to your philosophy where you said, we're looking at this not as a private equity investor per se, but a little bit because you're looking at the entire business. So it makes sense that your fundamental research is leading you to names that would also be interesting acquisition targets for other companies.
no,
So that,
absolutely. Yeah,
yeah.
some of the partners here at the firm have that private equity background, corporate finance background. So having those views into the process, into the committee also helps a lot.
You are one of those people. I love it. That's a great tie back to your backstory. Okay, let's take this one. I'm going to do the general question and then I've got to get some intel on EM, as a fan of EM personally, and I know a lot of us are. Okay, so we're in an environment here that's very volatile. What are the things that you're looking at? What indicators or kind of bellwether metrics are you looking at in an environment like this? And let's start kind of big picture, and then let's go down to EM if we can and talk about catalysts there.
Wow, from the macro to EM. Okay,
Yes,
great.
because we only have 7 minutes, so I got to get it in.
Let me get on to it. So let me start, Stacy, by saying we do publish a monthly report that shows the key variables that we look at. As I mentioned, we don't like secrets. We don't like what's
Yeah.
happening within a black box. No, it's all open. And we publish this every month. It's a monthly market view. Visit AZTLANEM.com if you want to take a copy of that. We publish it on LinkedIn. What do we follow in our both macro and micro, top down, bottom up? First and foremost, what we're looking at is corporate earnings. That's the key variable in our business. Corporate earnings. It could possibly be the case that we have a recession or a hard landing, whatever that means, but companies or certain companies are keeping up with their earnings. That's what's key. Let's look at earnings. So we keep track of that. We want to look at where our corporate earnings right now. We're earnings revisions. It's part of our quant process, the whole earnings revision equation. And want to make sure that if earnings are going down, they're within a reasonable range, and if not, then what's going on, and what are the actions that we need to take in terms of construction, how we incorporate that in terms of the risk profile of what we're doing in terms of the final portfolio construction, the diversification factor. So we look at corporate earnings. We look at obviously in terms of the macro growth, consumer sentiment, very important. And without getting too much into the philosophy of this, but what is money?
Yeah.
Huge question. But we look at interest rates, and interest rates set the bar for everything else. So we look at interest rates, definitely. The relative or the ratios between the risk-free yields and the equity yields, that's also very important. These are the kinds of the macro things that we look at. And then in terms of country, regional, or asset class allocations, well, we have all our models. Our models are built by design as bottom-up tools. So what we do is we assign scores company by company, and then we aggregate by sector, by region, by country, And that is what gives us a view in terms of where are the most interesting opportunities or overweights versus the benchmark in terms of sector, regions, countries, etc.
That's interesting. Yep.
And
Love
then,
that.
and then obviously the overlay that we mentioned. We have all these inputs that are geopolitics, that are macroeconomic in nature. We have the inputs from the research that we do, from the work that other specialists do. And with that, we come up with our final portfolio construction and our management process. In terms of emerging markets, let me tell you, we don't have a asset class allocation model that we follow, but we do have a good idea of how that will look like. It's work in progress.
Yeah.
Um, and it will look like very similar to what we've described, to what we do have right now, which is in the separate buckets, developed and emerging. If we look at emerging, there's significant headwinds and it's problems in terms of emerging markets, and that are the reasons why the asset class has underperformed in the aggregate over the last 5 and 10 years.
Yeah.
You really need to do either stock picking or go very selective in terms of countries, and there you have really very bright outperformers and really interesting, attractive opportunities. And I'll connect this with your question in terms of the benchmarks. Unfortunately, the benchmarks are very heavy China, and China is where most of these problems are. We have, we can dedicate, a couple hours just talking about risks that are coming out of China. And if we go back 5 years ago, in addition to China, we had Russia. Russia is now unavailable. It's now out of the indices, but we have these kind of geopolitical and economic, macroeconomic risks associated with emerging markets. In terms of China, the whole real estate sector is problematic. That has direct implications, direct connections with the financial system in China. Then you have the geopolitics. We talked a little bit about that with the nearshoring phenomenon. So I think in terms of emerging markets, the first step would be, in our view, to just look at EMX China. Just we have the developed markets ex-US, but just for diversification reasons, US investors are already well taken care of in terms of their US exposure. We have DMxUS. I think EMX China is really what would be a first step in terms of evaluating interesting opportunities in emerging markets. Not to say that there aren't good opportunities or great companies even in China, but I think as a whole it's problematic on the one hand. On the other hand, you have experts, local experts, that do a very good job in terms of stock picking.
In China, you're saying?
In China, yeah. In China.
Yeah. Yep. Thank you for touching on EM for us. And I want to end with one more thing, one more question I had. It's a big one, kind of. It's kind of a greatest lesson learned or lesson learned question. I like this because, again, going back to the qualitative, if I put myself in the shoes of an investor, I want to get from you the things I can't get from other places. So given your illustrious career and, the +1 vote you have for the most interesting man in the investing world, which, by the way, Alicia, you should put the link to that blog we did about Alejandro. It's so fabulous. So you can see why he gets my vote. But talk about that. Like, if someone said to you, hey, what's a lesson learned? We won't say greatest, it's too hyperbole, but what's a lesson learned for you as you've started AZTLAN that you're taking with you here?
Great question, Stacy. And I think I hadn't thought about this particular question for this webinar.
Sorry.
No. I do have a great lesson learned.
Okay.
And that is to not to be dogmatic in terms of investments. It's a key investment management lesson learned over the years the hard way. Losing my own money in investments. Why?
Talk more about it. Yeah.
If you're dogmatic, you position yourself as, let's say, a value investor. If you're a value investor, right, that's the tag that you apply to yourself. Then you're going to look for cheap companies. And if a company is cheap, then that's what you do. If you're dogmatic, dogma comes from a word that has to do with the doctors. The doctors are the ones who know, the seniors. So it's taking the ideology from someone else and, hanging on to that ideology from someone else. That's being dogmatic. Being dogmatic is not being flexible. Being dogmatic brings a lot of problems. So not being dogmatic is the key lesson learned in investments. And I think it has served us and our clients well. When things change, you need to change. When you approach an investment, you need to approach an investment opportunity with an open mind. You need to be able to contrast opposing views in your own mind when you're evaluating an investment. And if you're dogmatic, you cannot possibly do all these things. You're stuck with a dogma.
Yeah. And I would imagine too that in the investment committee, I mean, if we could be a fly on the wall, right, there's probably some pretty healthy debate of challenging each other and keeping each other honest around that, which I love.
Exactly.
So
that's one of the reasons precisely why we don't have a voting system in the committee. We don't want to be dogmatic.
yeah,
We want to have the ideas take the center stage.
yeah, intellectually challenge each other. I think
Yeah.
that's a hallmark of a good team that probably doesn't get talked about enough. So, Alejandro, this has been wonderful. We could sit and talk for hours, and I look forward to the next time we get to do this. Thank you so much for being here, and thank you everyone for joining us. If we didn't get to your question, don't worry. The AZTLAN team will reach out. Make sure you get that question answered. And if you'd like to learn more about what the team's doing and dive into the nitty-gritty on some of these strategies, please reach out to schedule a follow-up call. We will put this webinar through compliance. Once we get the green light, that will go out to you. I know we've had some requests for the replay. And again, encourage you to sign up for the research. We've alluded to it multiple times. Alicia's put, a gazillion links for you in the chat. So you can go enjoy the research the team is sharing and follow them on LinkedIn. This has been a pleasure. Thank you very much, Alejandro, and everyone who's here. Until next time, thank you.
Thanks, everyone. Thanks.
Take care.
Take care. Bye.